Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Elong Power.
And if you find our talks useful, please consider subscribing, liking, and commenting underneath.
So today we're looking at a situation that, well, it really shouldn't exist.
It really shouldn't. The data points we're seeing on Elong Power are, they're so contradictory you'd think the software had a glitch.
It looks exactly like a glitch.
Yeah.
You got a stock that's trading for pennies, right? Or around 33 cents.
Yeah.
While the smartest, most sophisticated institutional money just agreed to pay almost 10 times that for the exact same thing.
It's like seeing a car listed for $1,000, but then you watch a professional collector walk in and happily pay 10 grand for it.
Right.
You just have to stop and ask, what on earth do they know that I don't?
Or what is the market missing here?
Exactly. So we're digging into the market data from February 2026, press releases on a huge capital raise, and their financial filings.
And the mission is to figure out if this is a trap for retail investors.
A cheap stock that's cheap for a reason.
Or if this is one of those, rare moments where the market has just temporarily lost its mind and created a massive opportunity.
It's the classic price versus value debate, just taken to an absolute extreme.
Let's jump in. And we have to start with the what just happened moment. Because on February 4th, Elong Power would have set off every single alarm you have.
Oh, for sure.
It was unavoidable. It wasn't just active. It was officially one of the most active stocks across the entire market.
Okay, what kind of numbers are we talking?
We saw 56.3 million shares change hands.
In one day.
In a single trading session.
Wow. And to put that in perspective for everyone, because 56 million is just a big abstract number, what's normal for them?
Not even close to that. Normal for them is roughly 8.2 million shares.
Okay, so overnight you get a surge of, what is that, almost 7 times their average?
It's a 6.8 times surge.
Yeah.
A nearly 700% increase in activity. That's not a blip.
No.
That's a tidal wave.
So when you see that kind of volume, a 7x surge, you expect the price to be exploding, right? Up 50, 100%.
You'd think. But no, that's not what happened here.
And that's what makes this so weird.
It's the first layer of the mystery. The stock is just sitting there, around 33 cents. And if you look at the 52-week chart, it looks terrifying. The high was over $8. Now it's at 33 cents. Visually, that usually screams one thing.
Bankruptcy. Or, failed company.
Exactly. It looks like a company spiraling the drain.
Yeah.
So your first instinct, seeing 56 million shares traded on a stock down 95% from its highs, is to assume it's a fire sale.
Everyone's rushing for the exit.
That's the intuitive reaction.
Yeah.
But you have to look closer. This wasn't panic selling. This was churn. And more importantly, it was all happening just after a specific financial event that wrapped up only 48 hours before, on February 3rd.
The public offering.
They closed a public offering.
Okay, so let's unpack that. Because usually when a microcap company does an offering, it's like the kiss of death for shareholders. They print new shares, dilute everybody, and the price just tanks.
It often is. But this is different.
So why are we looking at this one as a bullish signal?
Because of the price tag.
Yeah.
This is what we're calling the $3.16 disconnect.
Okay.
On February 3rd, Elong Power closed a $7.6 million offering. They sold units to investors to raise cash.
And stop right there. Institutional investors. So we are not talking about like day traders on Reddit.
No.
We're talking about firms with due diligence teams, lawyers, the whole 9 yards.
Correct. These are the people who read the footnotes.
Yeah.
And the price they agreed to pay was $3.16.
I just want to let that sink in for a second. Sophisticated investors gave this company millions, valuing it at $3.16 a share. But I can go on my phone right now and buy it for 33 cents.
That's the reality of the situation.
That's a 9.5x difference. It's almost 1,000% spread between the market price and the institutional price. Why does that happen?
Well, there are mechanics to these deals.
Yeah.
You can't just buy millions of dollars of a microcap on the open market without, sending the price to the moon.
Right. You need a block trade.
You negotiate a block deal.
Yeah.
But the key takeaway isn't the mechanics. It's the valuation anchor.
They anchored the value at $3.16.
Exactly. They looked at the books, the tech, the contracts, and they said, we are willing to put capital at risk at this price.
Which creates this massive market inefficiency. The open market is screaming worthless, but the private market is saying, no, this is worth 10 times more.
It's a huge disconnect. So for a trader looking at this, that $3.16 level isn't just some random number from the
So it's
past.
a validated price level.
It's a magnet. It creates a technical setup for what's called mean reversion.
Meaning the price should, in theory, snap back towards that higher value.
Physics tends to take over with a gap this wide. Either the institutions are, colossal idiots who just burned $7 million,
Unlikely.
or the market is wrong and the price has to move up to meet reality.
It's like buying a house for $30,000 because the neighbors are spooked, even though the bank just appraised it at $300,000 2 days ago.
That's a perfect analogy.
Yeah.
You're buying the appraisal gap, but we have to be skeptical.
Right.
Maybe the house is falling apart. Just because a fund paid $3.16 doesn't automatically mean the company is solid. We need to look at what Elong Power actually does. Is this a real business?
Good question. Because trading at 33 cents implies the business model is broken. Are they just another generic battery company?
No, and this is crucial. They are not generic. They are a high-power lithium-ion battery manufacturer. And the key word there is high power.
Okay, break that down for me. What's the difference between a high-power battery and, say, the one in my laptop?
Think about the rate of discharge. Your laptop, or even a normal EV, needs high energy. It needs to last a long time on a steady drain of power.
Right.
Elong targets a different niche, construction machinery.
Oh, like electric excavators, cranes,
Yeah.
big heavy stuff.
Exactly. Think about an excavator lifting 3 tons of rock. It needs massive, instantaneous bursts of torque. A standard EV battery would just overheat or fail.
So they specialize in batteries that can deliver that explosive power safely.
That's their specialty. And it's interesting because it lets them avoid the red ocean of the passenger car market where everyone's fighting on price.
Yeah, that's a race to the bottom.
Precisely. This niche is harder to engineer, which means fewer competitors. And they're also getting into large capacity energy storage systems, grid scale stuff.
Which is a booming market with all the solar and wind farms coming online.
Right. But here's their moat, the thing that protects them. They don't just sell the battery cells. They have an integrated approach. They engineer the modules and, most importantly, the battery management system, the BMS.
The software brain.
Yes. And once a manufacturer designs their machine around Elong's BMS, the switching costs are incredibly high. You can't just rip it out and drop in a competitor's cheaper battery.
It would mean redesigning the whole machine's nervous system.
You got it. It creates sticky revenue.
Okay, I like that. So real product, defensible niche. What about the financials? Is bankruptcy the risk here? Because it's the other reason a stock hits 33 cents.
It's always the #1 fear with microcaps. But again, the data says something different. The company's market cap right now is about $19.7 million.
Tiny.
Very tiny. But they just raised $7.6 million in cash.
So do the math. That cash injection is.
It's about 39% of their entire market cap.
Wow.
Imagine if your net worth was 100 grand and someone just handed you 39 grand in cash. It's a fundamental change to your financial stability.
That is not keep the lights on money.
No, this is dry powder. It cleans up the balance sheet, takes the immediate threat of bankruptcy off the table. It gives them the runway to actually execute their strategy.
Okay, so the immediate bankruptcy risk seems low. Now, I saw a number in the notes that I honestly had to read twice. The PE ratio.
It is the weirdest part of this whole story. Their price-to-earnings ratio is sitting at 1.56.
1.56 for a tech manufacturing company.
It's basically unheard of.
I mean, let's put that in perspective. High-growth battery stocks trade at, what, 20, 30, 50 times earnings?
At least. Even a boring old utility company trades at 15 times earnings.
A PE of 1.5 usually means the market thinks the company won't exist in 18 months.
Or that the earnings are completely fake. It implies extreme skepticism. The market is pricing this for absolute failure.
But we just established that the smart money bought in at a valuation 10 times higher.
And that's the conflict. The market is pricing it for death. The institutions capitalize it for growth. If those earnings are real, the multiple expansion alone is a massive opportunity.
Just to get to a modest PE of, say, 10, which is still cheap for a tech stock, you're talking about a multi-bagger from here.
Exactly. It's pros for a worst-case scenario that the recent cash raise seems to have prevented. It's an incredible asymmetry.
Now, who are these institutions? Is it just hedge funds trying to flip for a few pennies?
The feed highlights a really important detail here. The biggest owners of Elong Power are private equity firms.
And why does that distinction matter?
Well, Hedge funds are often momentum traders.
Yeah.
They buy today to sell tomorrow. Private equity is different. They're business builders. They operate on a 3 to 5 year timeline.
They don't care about the price next Tuesday. They care about the price in 2029.
So if PE firms are the biggest holders and they're holding through this 33-cent dip,
It suggests high conviction in the long-term plan.
right, and that 56 million share volume we saw, that starts to look a lot like accumulation. Big players soaking up cheap shares from retail traders who are panicking.
A transfer of ownership from the impatient to the patient.
Exactly. And one quick note, the automated news sentiment scores you see for Elong, they're all neutral.
Which seems weird.
It's because the algorithms are, well, dumb. They see public offering closed and they can't tell if it's good or bad. But a human looks at the substance. A completed raise, that's bullish. PE ownership, bullish. The automated score is a false signal here.
Okay, so the setup is there, but what triggers the move back towards $3.16? What are the catalysts we should be watching for in the next quarter or two?
Three main things. First, capital deployment. They have the 7.6 million. In the next 6 to 8 weeks, we need to see announcements.
We want to see new factory line, new R&D, new contracts, not executive bonuses.
Exactly. We need to see that money working. Second catalyst is earnings, probably late April.
And there we're looking at revenue and cash burn.
We need to see that they're using the new capital efficiently. And finally, you have the macro tailwinds, the energy storage boom.
There was also that geopolitical angle, the whole China-based but NASDAQ-listed thing.
Right. Which is a risk, but there's a flip side. Western companies are desperate to diversify their supply chains away from giants like CATL.
So Elong could position itself as the safe alternative.
Potentially. A NASDAQ-listed company with transparent reporting, but with the manufacturing cost advantages of China. It's a clever position.
A smart angle, but we have to play devil's advocate. Why is it at 33 cents? What's the bear case?
And we have to be clear, this is a high-risk play. The number one risk is execution.
Having money isn't the same as making money.
Exactly. If they burn through that 7.6 million without growth, then they enter the death spiral of raising more money at lower and lower prices.
And the competition.
It's fierce. They're swimming with whales like BYD and LG. They can't win a price war. They have to stick to their high-power niche.
And finally, the volatility is just insane. The 52-week range is 25 cents to $8.
Yeah, if you're an investor who can't sleep when a stock drops 10%, this is not for you. This is risk capital only. It's a roller coaster.
So let's pull it all together. What's the final thesis?
The thesis is a high-risk, high-reward swing trade. The technical setup is a classic mean reversion, targeting that offering price of $3.16. That's your North Star.
And it's backed by a PE of 1.56 and a freshly flushed bank account.
The downside is cushioned by the cash, and the upside is the gap to that institutional price. My confidence in the value is high. My confidence in the timing is low. It could take 6 months.
It requires patience. Which brings me to the final thought I want to leave everyone with.
What's that?
The market right now is valuing this company as if it's dying. It's screaming, game over. But the most sophisticated investors, the private equity firms, just wrote a $7 million check to help it live. And they paid 10 times the current price to do it.
That is the core conflict.
So the question you have to answer is, who is right? The daily chart that flickers every second, or the private equity checkbook that's planning for the next 5 years?
Usually the checkbook knows something the chart doesn't.
Thanks for joining us. If you enjoyed this breakdown, make sure to follow the feed for more analysis. We'll catch you in the next one.